Hi all. This video I'm just going to go over those two practice questions at the end of chapter 12 on intangibles. I mentioned them at the end of class and said, give them a try, and you've got the solution posted, but figured you'd want to hear the sound of my voice. So this first one, the mock exam question, is a goodwill question by acquiring a business. So similar, we've got a list of assets and liabilities we acquired. In this case, we bought the company, so we also have common shares and retained earnings on here. Please remember, you just ignore those. Okay? There's the numbers that are on their books. Underneath, there's some statements as to how much we paid, and is the fair value different than the carrying amount? So in this one, the inventory is only worth $60,000, not the $75,000 on the books. And the planned assets are worth $550,000, not the $420,000 that's on the books. So again, we're going to record everything at fair value, not book value. And it was also agreed by the parties that the shrinking trademark was expected to have a 10-year life and be worth $25,000. Trademark isn't even on their balance sheet, but it is an intangible asset that was identified, and we have to record it as well. We're going to acquire all assets and liabilities for $1 million, paid in cash. So again, the journal entry is record all the assets you acquired at their fair value, record all the liabilities you acquired at their fair value, ignore the common shares and the equity, record whatever you paid. So in this case, we're going to credit cash for $1 million. And then to balance the entry, you're going to need to debit something, and that's goodwill. Okay, so if we go look at the entry, we will see there's the cash we acquired, the accounts receivable we acquired, the inventory at its fair value, the plant assets at their fair value, the trademark at its fair value. Let's ignore goodwill for a second. The long-term debt and the accounts payable at their fair value, which was what was on the books, and the cash we paid out. And if I have everything there, the number I need to balance it is $395,000 debit, and that's goodwill. Goodwill is the difference between what you paid and the fair value of everything you can identify that you acquired. And in part two is just a little amortization question. Record the expense. So it was $25,000 with a 10-year life, so we're going to use straight line. We'll call it amortization expense. Again, the credit, you can put it to the trademark, or you could put it to, you might want to call the account intangible dash trademark, or you can use an accumulated amortization account. So accumulated amortization trademark. Any would be acceptable. Okay, so that's that question. This other question is, we've got some impairment and we've got a couple of calculations to do. So first off, we acquired these things and they have fair values. And just to go back to an old concept, the fair values of these two don't add up to what we paid. Essentially, we got a deal because we bought them both. So in order to figure out how much of the $1 million I allocate to each one, I have to do a pro rata calculation. This is not an acquisition of a business, so I'm not going to record goodwill. That would be negative goodwill anyway. I'm not going to record a gain because of that. I'm going to just allocate how much of the $1 million relates to trademark and patent, as we did for bundled purchases early on. So that's essentially the math for Jan 1 215 purchase. And then it wants amortization on the assets. So again, we're going to review amortization, but we've got the number of years. It's straight line. It's a whole year, so it's not bad. And then a few years down the road, we determined that it might be impaired, so we have to take a look. So we go and get these three criteria. Undiscounted cash flows, value, and use fair value. Again, remember, we're always using IFRS. One little trick here, make sure that all the amortization is recorded up to December 31st, 2018, because you need to record the depreciation before you look at the impairment. And then just do the impairment test, and if it's impaired, book an entry. So here's our first one. part, I'm just doing that allocation. Where does $1 million go pro rata between those two assets? My amortization expense based on 10 years and 8 years. Oops. Amortization for whatever year this is, 12/31/2018. Now, to figure out whether it's impaired or not, I need to get the carrying amount. So make sure you get the years right. In this case, I believe I bought it January of 2015, and now it's the end of 2018. So I need, if I'm looking at carrying amount, it's going to be cost minus 4 years, right? 15, 16, 17, 18 of amortization. So that's where I get the carrying amount of 354. I'm going to compare that to the recoverable amount, which is the greater of the value in use and the fair value. So 315 is my recoverable amount. My book value is 354, so it is impaired, and it's impaired by the difference between those two numbers. Impairment loss and trademark. Again, if you want to use accumulated impairment losses trademark, that's fine. Okay, so a couple of good practice questions. Covers amortization, covers goodwill, covers a little bit of mathing, covers impairment. Any questions, give me a call. Thanks.